Hey guys, how you doing?
Doing good.
Good.
Awesome, awesome, awesome. I'm Alonre with Berkshire Hathaway.
Danielle Ramos, your mortgage consultant.
Mike Miller with Arch Mortgage Insurance.
Awesome.
Thank you for joining us today, Mike.
Absolutely, my pleasure.
Yeah. So we recently, Alonre and I, closed on a purchase deal, and our borrower had your lovely mortgage insurance to be able to purchase his home. And I thought it'd be great to bring you on and discuss mortgage insurance and let people know a little bit more about it.
Absolutely.
Awesome. Awesome. Before we go into what mortgage insurance is, what kind of impact are you seeing on your business right now due to the COVID-19, fiasco?
Well, I would say that a lot of people have the same questions, and we're still trying to figure out what that's going to be. Clearly, with this whole forbearance, program, things of that nature, as a mortgage insurance company, we're obviously wondering, how's that going to impact us, when it comes down to the end of these forbearances. So we're taking the necessary steps, obviously, to research and kind of figure out, okay, what's the next rational decision that we need to make. And clearly, with the way the economy is going, we're seeing price changes. We're seeing different MI companies getting out of the higher risk products that we're seeing out there, cash out investment properties, for instance. And we're kind of countering that with, pricing and things like that, but we want to stay in that market. We're still currently active in cash out and investment properties, but clearly this is areas that are going to be questionable in the future and how we're going to handle these types of things. But aside from that, we're trying to handle business as usual and continue to do what we do.
Nice, nice, nice. All right, Danielle, I'll let you take the floor.
Perfect. So we'll jump into the different types of mortgage insurance. And Mike, let's start with the one that, kind of seems typical, borrower paid monthly.
Yes, borrow and paid monthly probably is about 70% of our overall business. That's probably the most common type of mortgage insurance out there. Essentially, borrower paid monthly is a monthly mortgage insurance that's applied to any loan over 80% loan to value. Mortgage insurance is required by all lenders for 80.01% and above, basically taking the risk off the lender and placing it onto the mortgage insurance company, essentially protecting the lender from any type of default. So with that being said, with the most common being monthly is just a premium based off the overall loan amount. And with Arch Mortgage Insurance, we were the originators of what we call risk-based pricing. So when Danielle goes in to price out an MI quote, it's based on 15 different factors, essentially in a nutshell, and 1.4 million variations in pricing. So there's no
1.4 million, right?
1.4 million variations of pricing based on overall risk. So that kind of benefits the borrower in a lot of ways because it's obviously risk-based. So, the better, the less the risk, the better the pricing versus a general standard pricing like a rate sheet where it's just DTI and FICO and here you go. So it gives a lot more variance as far as pricing goes and how we could price out that loan.
Nice.
I'm so glad that I have that program to calculate all those options in there and I don't have to sit and figure it out myself.
1.4 million.
I'm so glad I don't have to deal with it. That's Danielle's job.
Yes, yes.
So again, the borrower paid monthly, that is included in the borrower's monthly payment and comes into play with their debt to income ratios.
Yes. So with monthly, and I'll kind of spin this off because this is what it's going to play into, is MI cancellation, which is one of the most common questions that come up. Be a realtor or loan officer. Equally, this question is probably one of the most common to educate the borrower on. So back June of last year, Fannie and Freddie came out with a revised guidelines on requirements for removing mortgage insurance. And I won't go too far into that, but just want to kind of elaborate on the fact that they released new guidelines that kind of simplified the process in releasing mortgage insurance. So they used to require, the acknowledgement in writing, and they required a full appraisal to document 80% loan to value or less.
Yeah.
Well, now they'll do it verbally and with an AVM. So essentially what that means is, from a mortgage insurance company, Arch being that, we do not care when the MI comes off. It's not up to us, and we don't determine that. The servicer determines that. So with a monthly MI, borrower has that, and they say, okay, well, when can I take this off? They can request that to come off at what they consider 80% loan to value. So if they're looking on Zillow, Redfin, whatever, and they think their value is 80% or less, they can then start requesting that with their servicer. So the servicer will then, look into it and find out, okay, yes, they're at 80% or less, and we're going to go ahead and release it at that point. So once the servicers determine that, they'll send us a request, and then we release it. So that's kind of how MI cancellation works. Did you get that?
Yeah, we did.
I'm making sure that didn't go too far.
Just a little bit.
Yeah. So
no, that's good information. I'm sorry, go ahead.
Yeah, it comes down to the servicer. A lot of people call the MI company wanting this, done, and same with the customer. But if we can honestly, relay this to the customer, that it's not the scary 4-letter word it used to be. It's really a pretty simple process, and really, in a nutshell, MI is not that expensive an alternative, especially when you're looking into getting into a home. So,
thank you for that one. So we'll jump to the next option, borrower paid single. So that's, you give the explanation, Mike.
Yeah, so borrower paid single is another option in which, borrowers can use funds available to them and actually buy out the MI premium up front with their closing costs. So,
all right.
Yeah, so that's oftentimes a good option because people don't want to see that additional payment, or they don't want to, look towards, paying an MI of what they consider forever, but it's really not forever. It's really just to determine on, how long they have the loan, where they're at as far as total down payment. Are they at a 97 or are they at 82%?
Right.
So really it comes down to how long are they going to have it, and when can they take it off, and does it make sense to pay that upfront sum, and pay out that, but they can absolutely pay that out as a borrower paid with, their source of funds, being their own or credits. So
right. And that's an angle that I like for Alana and I to have, is because sometimes you need that borrower to have a lower debt to income ratio to be approved for the loan. And then also we sometimes have the option of a seller credit where maybe, those extra funds can help the borrower pay that premium up front.
Correct. And then it's gone. The borrower doesn't have an additional monthly payment, and it's paid for up front and gone, and they can. And especially today with the rates as low as they are, it's a good opportunity to say, hey, I'm at 3.25. I don't have anything else. I'm keeping this loan forever. I'm done. Yeah.
Yes, exactly.
That's a good option. Thanks a lot for that.
Yeah.
All right. And then our last one.
Okay.
Lender paid. So lender paid being the last one. Essentially, a single just rolled up into the actual loan itself. So it would be a lender paid, and whoever the lender's doing the loan would be paying us that premium, and it'd be simple as a single to us, but just paid for by the lender.
Right. And I know maybe for another discussion down the road, but sometimes I have my borrowers look at the option of the borrower paid versus lender paid. Sometimes you might have a slightly higher interest rate, but depending on each individual's ability to have mortgage insurance possibly written off versus the interest, that's another option that I have people look at. So that was good, all of those 3 options. Any questions, Alana?
I'm just trying to, digest all the information. It's good stuff. I do appreciate it.
Yeah, I mean, another, a point to, having monthly too, is now they brought back the allowance of a tax deduction. So now you can actually, so now you can actually write off the MI as well. So that's an additional benefit.
That's good. That's good. That's a good selling point. I love it.
Yes, yeah, exactly. You say, yes, you've got to pay this additional, monthly amount, but it's a tax
Yeah.
deduction as well.
You can write it off. So
Yep,
that's how that works.
exactly.
Nice stuff. Nice stuff.
Every angle to close a loan, right?
Hey, why not?
Absolutely.
All the tools that we need, right?
Absolutely.
Good stuff. Good stuff. Good
Yeah.
stuff.
Well, perfect. I appreciate your time today, Mike, and you
Absolutely.
too, Monterey.
My pleasure.
Yeah. No, but guys, thanks a lot, Mike. We will be doing more and more deals with you. You did an awesome job. We just love you, man.
Yeah,
Thanks.
appreciate it. Anytime. And I've talked to Danielle. If you guys want to, sponsor an event or do something, you guys together and do something, let me know. We'll put something together for everyone.
So now we're recording this. So if you want to sponsor an event, you're gonna foot the bill, right? I love it.
TBD.
No, it's all good. It's all good. No, thanks a lot for that, man. We really appreciate it. Thank you.
Yes, absolutely. Anything to help Danielle, I'm all for. So let's.
Wait. Anything to help Danielle? What about me?
Hey,
You're part of the same party.
Just want to make sure.
Yes, absolutely.
Absolutely. Right,
Where Danielle goes, I go. So we're all one team here.
There you go. I love it. All right, sounds good.
All right, guys. Take care. It's a pleasure meeting you, Lonroy.
All right, same man. Pleasure, guys.
bye.
Bye.